All right, welcome to This Explainer, where we're going to completely demystify the high-stakes world of process costing. If you've ever wondered how massive operations like oil refineries, paint manufacturers, or huge beverage factories actually track their millions, well, you are in the exact right place. Today, we're taking you right off the textbook page and straight onto the factory floor to show you exactly how identical units flow through a production process and how all those crazy numbers finally add up. So, here's our game plan for today. We're going to build your understanding step by step. We'll start with job versus process costing, tackle the WIP and equivalent units, look at losses, gains, and inspections, compare FIFO and weighted average, and then lock it all in with a foolproof 5-step exam framework and a real case study. Let's get moving.
Okay, kicking things off with Section 1, Job versus Process Costing.
Let's anchor ourselves in reality here. Think about the massive contrast between, say, a custom furniture builder and a gigantic chemical plant. The furniture builder tracks every single nail, every piece of wood, and every hour of labor for one bespoke chair, right? That's job costing. But a chemical plant? It's continuously churning out millions of identical vats of liquid. Because every vat is exactly the same, tracking individual costs is literally impossible. So instead, we use process costing. We accumulate these massive pools of costs over a specific period, and we just average them out across all those identical units.
Moving right along to Section 2, the WIP and equivalent units.
Now, as we're walking through our chemical plant, we hit our absolute biggest accounting roadblock, the end of the month. Imagine you have to suddenly stop a factory's conveyor belt halfway through baking a batch of cakes. You've got fully finished cakes perfectly ready to sell, sure, but you also have pans of half-baked batter. That's the problem of work in progress, or WIP. We have to figure out a mathematically fair way to split our accumulated costs between those fully finished goods and the stuff that's only halfway done.
And that brings us to our brilliant mathematical solution, the equivalent unit. It's essentially an imaginary, fully complete unit. Think about it like this. If you have 200 vats on the floor that are exactly 50% complete, mathematically speaking, that exact same effort equals 100 fully completed vats. If they were 25% complete, that's 50 equivalent units. 75% complete, 150. You get the idea. This system standardizes our messy physical reality so we can actually calculate a precise cost per unit.
Visualizing this on a production timeline is absolutely crucial. See, raw materials usually drop into the mix right at 0%, but conversion costs, like the factory labor and overhead, those accumulate gradually all the way to 100%. This means a vat that's only, say, 10% processed might actually already have 100% of its raw ingredients dumped in. Because these inputs enter at totally different stages, we have to calculate our equivalent units completely separately for materials and for conversion costs.
All right, let's jump into Section 3, losses, gains, and inspections.
We have to face the hard reality of physical manufacturing. Things spill, they evaporate, they get ruined. To track this, we build our process account. It's just a massive T account showing every single input cost on the debit side, which has to be perfectly balanced by our outputs on the credit side. Behind the scenes, we're debiting for opening WIP, direct materials, labor, and overheads. And on the credit side, we track exactly where it all went: finished output, closing WIP, and crucially, our factory losses. Now, it is vital to understand the difference between normal and abnormal loss. Normal loss is your expected wastage. Think standard evaporation. It's totally unavoidable, so we just absorb that cost into our good units. It's the cost of doing business. But abnormal loss, that is a giant red flag. Think total equipment failure or someone accidentally driving a forklift right into a vat of acid. That is totally unexpected, so we separate it out as a period cost. This alerts management that they need to investigate immediately.
On the flip side, we have an abnormal gain. This happens when your factory floor is unusually efficient and you somehow end up with more good output than you anticipated. Basically, your actual loss was less than your calculated normal loss. And just like we do with abnormal loss, we separate this gain out to make sure our process account balances perfectly and to really highlight that awesome operational efficiency for the month.
Now pay really close attention to exactly where the inspection point sits on this production timeline. Why? Because if your closing work in progress hasn't reached this inspection point yet, you literally cannot hit those units with a normal loss calculation. This is a massive trap students fall into. Normal loss is only recognized for units that have actually been inspected. If your WIP is at 40% completion but the inspection doesn't happen until 50%, those units haven't been checked yet, so they don't share in the normal loss.
Next up, Section 4, FIFO versus weighted average.
So, what exactly do we do with the leftover work in progress from last month? Well, we have a head-to-head battle here. The weighted average method just dumps everything together, creating one giant blended soup of old and new costs. It's much simpler, but it kind of obscures your current month's efficiency. Then you have the FIFO method, first in, first out. This strictly assumes we finish the old batch first. By keeping those old costs completely separated, FIFO gives management a highly accurate picture of how well the factory performed during this specific month alone.
Section 5. The 5-step exam framework.
We are now transitioning directly from the factory floor into the boardroom. I want you to take a mental picture of this 5-step framework right now, because this is your foolproof, step-by-step method for solving these problems. Step 1. Draw out your process line. Step 2. Balance your physical units with a unit reconciliation. Step 3. Pick your valuation method, FIFO or weighted average. Step 4. Calculate your cost per equivalent unit. And finally, Step 5. Allocate all that money. Let's actually put this to the test.
Section 6, Case Study and Exam Mistakes.
Let's lock all this theory in with a fictional chemical manufacturing company. Think about our raw data here. We've got an opening WIP of 500 units, we dropped 32,000 pounds on new materials, and we expect a 10% normal loss, which, by the way, has a handy 2-pound scrap value. Using the highly precise FIFO method, we introduce 4,000 new units and we end the month with 3,800 completed. Let's see exactly how this all balances out.
Step 2 really reveals the magic of unit reconciliation, because your physical inputs absolutely must equal your outputs. Let's do the math. Our inputs, that's our opening WIP of 500 plus the 4,000 introduced, give us 4,500 units. Our expected normal loss is 10% of input, which is 400. But wait, our actual outputs show 3,800 completed plus 400 in closing WIP, which totals 4,200. Add the 400 expected loss, and we're at 4,600. Because our actual good output was higher than we expected, we have to balance this table with a triumphant abnormal gain of exactly 100 units.
And this brilliantly illustrates Step 4, where we actually calculate the cost per equivalent unit. But here's the crucial part. You must make absolutely certain to subtract the scrap value of your normal loss first. We take our current material costs of 32,000 pounds, but we subtract the total scrap value of 800 pounds. That gives us a net material cost of 31,200 pounds. We divide that new net number by our 3,700 equivalent units, giving us a highly precise material cost of 8.432 pounds per equivalent unit.
I want to raise a massive red flag here to warn you against some truly deadly exam traps. Never, ever forget to calculate equivalent units for your partial WIP. Do not ignore the exact location of your inspection point. Do not mix up your FIFO and weighted average rules. Pick one and stick to it. Never forget to deduct those scrap values in your normal loss calculations. And always, always force your unit reconciliation to balance perfectly. If you skip any of these, your entire process account is going to fall apart.
By bridging the gap between actual physical factory flows and the complex accounting mechanics, you now have the exact tools you need to conquer process costing. Keep this 5-step framework handy, and I guarantee your process account will balance perfectly every single time. But before you go, I want you to think about this. The next time you pour yourself a glass of orange juice or you're pumping gas into your car, ask yourself, just how many equivalent units are you actually consuming? Thanks for joining me on this explainer, and keep learning.